Module 2.5, Goal-Oriented Saving. Goal-oriented saving is particularly useful when it results in a reduced income tax liability by using tax-deferred accounts. Retirement is one prime area where any contribution that you make to your IRA or to your other retirement accounts is going to be non-taxable, up to defined maximums per year. If your employer offers an employer match, you should definitely contribute at least that amount every year to retirement because you're basically doubling your money. You should also contribute the maximum possible to your IRA, which is somewhere around $18,000, and this will reduce your tax liability. This is very important if you're in a higher tax bracket, such as the 25% bracket or above, which generally occurs when your income exceeds about $90,000 to $100,000 per year. As for health savings accounts, they're an excellent way to pay for medical related expenses because money that's contributed to them is not taxable, and there is no tax assessed either when you spend the money from these accounts. Planning for your children's college should be done with either 529 plans or possibly plans that your state government may offer to reduce the tuition. But as importantly as reducing the tuition is not having to pay income tax on that money. And typically when that money is withdrawn, you don't have to pay tax either. Whereas in retirement, you do have to pay tax, but since your income is going to be lower in retirement, it'll be in a lower tax bracket than you would pay now. How do tax-deferred accounts help? Of course, by helping your marginal tax rate. In 2016, for singles, income over $37,651 per year is taxed at a federal rate of 25%. Typically, if you're married with kids, you can make about $90,000 to $100,000 or more before you start being taxed in this bracket, due to the higher bracket amount for married people and due to deductions that you'll get for having children. In fact, even for singles, you're going to have a standard personal deduction of around $6,000 before any income tax begins to be applied. If you contribute to your retirement accounts or other tax-deferred accounts, the tax rate is 0% on that amount, and this means that the amount that is reduced is always your highest tax bracket. For example, if you make $60,000 per year and contribute $10,000 to tax-deferred accounts, you're going to be saving about $2,500 in federal income tax. And when the money is spent, generally there will be no tax or lower taxes. For example, in retirement, your income will be lower, and whatever money that you receive from your retirement accounts in retirement is going to be in a lower tax bracket anyway. Besides the tax benefits for goal-oriented saving, it can also be very motivating as well. You should probably make goal-oriented saving a habit, and instead of buying items with money that you don't have, you should save up the money and pay in full whenever possible. This will reduce the temptation of carrying a balance from month to month on your credit card, which will save you hundreds of dollars in finance charges per year, or perhaps even thousands of dollars. That doesn't mean that buying using credit cards is a bad idea. In fact, credit cards often offer significant rewards that will help you to have free travel or to receive cash back. However, you should make these purchases having enough money in reserve to pay for the purchases at the end of the month. Then you won't incur any interest while receiving the benefits of using the credit card.